Kriti Gupta joins us now with her chart of the day. We've been getting these so early.
I know.
It's exciting.
Do you like
I
them?
used to have to wait till the afternoon. Of course I like them. I'm subscribed.
As everyone else should be.
Yes.
But viewers and listeners, let's get to today's chart of the day, though. Put option volume. This is like a chart that a lot of people like to look at. You look at the put call volume to see where the options traders are kind of hedging their bets. But if you actually look at it right now, you've gone back to neutral. So basically, we're looking here for a radio audience at put option volume relative to call option volume. Essentially, bearish bets on the stock market relative to those bullish bets. And right now, they're hovering around a 1 ratio. And this is important because if it goes higher than 1, it means there's this kind of bearish bias in the market. If it goes below 1, there is a bullish bias.
So you're telling me right now, essentially, there's just no conviction.
I'm saying
Exactly.
Right. Exactly.
We're not moving the ball forward at all, Kriti.
Well, that's the point, that a lot of this kind of, because you have seen this upward movement year to date, that going more towards that higher on that 1 ratio. So that means that people have clearly gotten bearish, as we've seen with the red on the screen year to date. But also keep in mind that once it hits that 1, a lot of people are just kind of shifting to neutral when it comes to their bets. I mean, Chris Murphy, I think at Susquehanna, put it best. He said, it's a buyer strike. This isn't panic selling. This isn't a liquidity crunch the way it was in March 2020. This is simply people saying we're going to reevaluate and we're going to restart and kind of basically come back to zero.
Yeah, and Kriti, lots of people asking, are we nearly there yet? Have we found the market bottom? And as you point out, there doesn't seem to be a lot of conviction either way on the chart that you just produced. We were talking in the break about a report at a credit sites that talked about the rate of change in credit spreads and using that as an indicator of the market bottom. According to their research, 42 days, very specific, very precise, 42 days after you see this peak rate of change in credit spreads, that's when you tend to see the market bottom. I wonder what other clues people are looking for, though.
Well, I love that you brought up credit spreads because this is kind of the big mystery of the market. A lot of people look at, say, high yield credit spreads, for example, to see whether the credit market is going to break or whether the stock market is in fact right. And usually it's the bond market that's supposed to lead the stock market. And right now it seems the other way around, because if you look at it from a credit perspective, you don't see as many kind of warning signals or as many red flags in terms of credit spreads or high yield credit spreads specifically as you would traditionally when it comes to recession talk. So one of the arguments here, Anna, is the stock market perhaps over anticipating some of those recession odds? At least that's one of the claims in the bull market. Some other metrics to look at is, of course, commodities, whether or not they're seen as risk rallies or inflation hedges. And I think, to me, the dollar is really the story here. A weaker dollar, what does that mean for the stock market?